Hi everyone, welcome back to Atrium Research's YouTube channel. Today I have the pleasure of interviewing Arturo Prestamo, the CEO, and Andres Bedregal, the CFO of Santacruz Silver. Santacruz is a company within our coverage that trades on the TSXV under the symbol SCZ. We currently have a buy rating and a $1.60 per share target price on the company. This comes after increasing our target price on the company 2 times in the last week on big Q1 beats, which we'll get into in a moment. Arturo, Andres, great to have you here today.
Thank you, Ben, for having us here. It's a pleasure for us to be here with you.
Yeah, thank you, Ben. Thank you for having us here.
Absolutely, and we're excited to dive in. The story's obviously been performing really well. And before we get into the more sort of recent numbers as to why the performance has been so great, maybe Arturo, for the viewers that don't know the story, you can run through the presentation here quickly, and then we can get into some Q&A after that.
Absolutely, Ben. Well, I'll be making some forward-looking statements, so we apologize for that. We are a multi-asset, multi-metal, and multi-jurisdiction company. We have production both in Mexico and in Bolivia, 2 jurisdictions where we feel very comfortable working with. And actually, we have 3 producing mines in Bolivia, 1 producing mine in Mexico. In addition to that, we have 1 trading company in Bolivia, which complements nicely to our day-to-day operations. I'll describe that in more detail in a moment. For us, it's really important working in these 2 jurisdictions where, in addition of feeling very comfortable to be part of, these are very accretive jurisdictions for our business model. Bolivia, for example, has a significant amount of untapped mineral wealth. It's a country that has been underexplored for many, many years, and a country with a very vast, very long history of being a strong silver producer in the world. The economic impact of the mining industry in Bolivia, it's very important, up to 10% of the GDP of the country. So this industry is strategic industry for the country. The location is, of course, very important as well. It's in the central part of South America, and it plays a significant role in the mining industry around the neighborhood of Chile, Peru, Brazil, and Argentina. In addition to that, the exploration and upside potential in the country is second to none. We're very excited to see every day different areas where we believe a significant upside potential could be on tap. I mean, could be discovered and eventually converted into producing mines with significant exploration that this requires. In Mexico, it's a country where we feel comfortable working at, just a jurisdiction that it's well known for the mining industry for many years. The economic contribution for the mining industry is significant as well, and you have, as you may know, significant amounts of silver in the country. It's a mining-friendly jurisdiction, and we definitely are comfortable working here in Mexico as well. Our roadmap for growth and success has started since years ago, but in 2022, when we acquired all Bolivian assets from Glencore, that's when the company was taken into another level. In 2023, we achieved our historic highest production, and the historic highest production at these Bolivian assets, new for us. At the time, it was 1 year of transition, and this for us, it was so important because it proved that we were able to make a smooth transition and taking over these assets in a very solid way. 2024 was a year where we achieved also an important milestone where we renegotiate with Glencore the share purchase agreement for these assets, and that puts us in a position where we were now able to reinforce our balance sheet and being able to as well that allows us to start creating a significant amount of revenues coming into the company, and as such, our P&L and balance sheet were substantially solidified throughout the years and beyond. 2025, we're committing to achieve efficiencies across all of our assets and keep building our treasury, in addition to having a favorable environment on the metal prices. In addition to the efficiencies that we have been achieving, the company is now generating very strong cash flows and a strong treasury as we speak.
Ben, I think it is important to mention that since acquiring the Bolivian operation, we executed a clear action-driven strategy. As Arturo was mentioning, 2022 was all about boots, taking control, boots on the ground. On 2023, we ramped up production in Bolivia. In 2024, we did the same thing in Mexico, the same playbook. And starting Q3 2024, we focused on boosting silver recovery. So it was a clear and an action-driven strategy. Now we are focused basically in this 2025 in process optimization, maximizing payable metal per ton. And this, backed by strong financial discipline, has allowed us to deliver results, meet every obligation we have, included Glencore, and even tap into an accelerated payment option that we'll describe later.
Correct. Our base metals and I mean the metals that we are more focused in our production, it's silver definitely and zinc. For us, these two metals are very important. Both of them are metals that are industrial by its nature. Silver as well has the other component of precious metal, but both of them are industrial metals where we feel will be in a positive trend for the next coming years. On the right side, we have the production on a per mine basis, in addition to our San Lucas, the trading company that we have in Bolivia, which complements really nicely with our business, our mining activities, as I will describe in a moment. Coming into detail into our mines, we have the Bolivar mine. The Bolivar mine is a mine that has been running for more than 200 years continuously, with a lot of upside potential. We have a 1,100 tons per day milling facility, which today is about getting at 100% capacity. Today our revenues from the Bolivar mine are north of 50% coming from silver, and as you can see on our slide, 45% comes from zinc, and just a small portion from lead. The Porco mine is a mine with a long history, with more than 500 years of continuous mining activity. It's the oldest mine in the Americas, with a significant upside potential still. And today we have a 1,200 ton per day milling facility, which we use and leverage on the San Lucas trading company to use or have this milling facility at full capacity all year round, which makes it very accretive as our business model is designed. Finally, from our producing mines, we have the Caballo Blanco Group of mines. These are two mines which produce north of 1,000 tons per day, where you have a 1,300 tons per day milling facility, and silver revenues are close to 40% in today's metal prices, where zinc you have close to 60%, 56%, 55% from your revenues out of Caballo Blanco. And finally, in Mexico, you have the Zimapan mine. It's a mine that it's a bit different than our mines in Bolivia. You have, from a geological point of view, you have very wide ore bodies, skarn ore bodies, massive sulfides, which makes it very efficient to run from a mining point of view. You have as well a very competent rock. So this is a high volume mine, and the head grades are not even half from what we have in Bolivia. Nonetheless, the high volume and the competitive rock that we have at Zimapan makes it very efficient and a very, very promising, very profitable mine for us. Now more so as we're developing the level 960 at the Carrizal mine. This level is the future of the Zimapan mine in an area that we feel very encouraged that will be improving our economics at Zimapan. In Bolivia, we have, as I was pointing out, the San Lucas Trading Company or feed sourcing company. This is very strategic for us for many reasons, but it's generally speaking, it's a company that makes sure and provides ore to all your milling facilities, and with that we guarantee that our milling facilities are running at full capacity all year round. It has also a very interesting value-added approach where we also create value for all the small miners who are suppliers for San Lucas. We buy ore from small miners, we pay them in the banking system, in the official banking system, and this allows us to bring these small miners into the formal economy. We retain taxes on their behalf, and we pay them to the Bolivian government. That's also a contributor to the economy in Bolivia. At the same time, San Lucas makes a very thorough KYC process where we make sure that our small miners, our clients, are working at the best safety standards as possible, and that they have no child labor and some other important values of the mining industry that we believe should be taken care of. Finally, this last quarter, we just presented our financial highlights, and I'll leave Andres to describe them better.
Thank you, Arturo. Yes, this quarter we generated around 70 million in revenue, which was 34% higher than Q1 last year, and 30% below Q4, which is normal due to seasonality. Q1 has fewer operating days, and Q4 tends to be our strongest. So it's a normal Q. Adjusted EBITDA came of around 27 million, a major improvement from the negative 1.3 million we posted a year ago. Operation cash flow reached 6.3 million, and cash equivalents around 32.5 million. While our cash position remained broadly in line with year-end 2024, then, potentially given the impression that no additional cash was generated, it is important to highlight two key factors here. First, we made our annual tax payment for 2024. That was around $12 million, which was reflected in operating cash flow. You can see in our financial statements that. Also, second was we also made a $10 million payment to Glencore under the advance payment plan. So taking these two together, this exceptional outflow, our quarter was actually stronger than any other quarter, no? On the right side, as you can see, we reported a 20% year-over-year reduction in cost. We are around 70.84 in cash cost and around 22.34 in all-in sustaining cost. However, it's important to understand one thing. Our Bolivian operations adopted a new exchange rate methodology supported by IAS 21. We moved away from the official rate of 6.96 and now used a market-based rate of around 12.2. The reason is simple then here. The official rate no longer reflects the economic reality of the operations in Bolivia, as there are no real transactions taking place at that rate. So previously, as you were able to see in our financial statements, the impact of this difference was reported in FX gains, and it was considered temporary. But given Bolivia's structural and macroeconomic changes, this approach is no longer accurate. So under IS 21, we are required to use a rate that reflects the economic substance of the transaction. So now our reported figure reflect the reality of our operation. So to me, it is essential to tell our investors that from now on, this economic reality is reflected in how our costs are viewed. This is not a one-off or exceptional adjustment, but the new baseline going forward.
Right.
As you can see in this slide, the improvement in our balance sheet and overall position it's pretty evident. As you can see, there is a clear step up from 23 to 24 and a further improvement in Q1 2025. This was driven by a combination of two things. We have improved our operations, we have reduced our liabilities by paying our suppliers, our taxes, etc., but also because of this exchange rate. Remember, the exchange rate also affects assets and liabilities. However, liabilities were influenced much more than assets. So our financial position is much more strong right now. We went, for example, of having 1.4 to 1.6 current ratio, meaning that we have $1.6 per every dollar we owe in the short term. So our equity position also strengthened significantly, giving us not just a well financial position, but always it put us in a great position to increase our revenues and to comply with our long vision.
Well, as Andres has pointed out, Ben, the company is now with a very strong balance sheet and we'll keep making it stronger as days go by. We have a strong treasury today. We have a very clear plan going forward to amortize the $40 million payment on the accelerated plan that we execute late in early this year. And we're on track to make these payments and finish by the last week of October. That will save us $40 million on this share purchase agreement, and we'll keep going that route. No? Today, our treasury is strong. We have north of $60 million in our treasury. So we're comfortable that we'll keep walking as designed or amortization plan for all those $40 million payments. Mm-hmm. Over the last quarters, we have been seeing, as you can see in this chart, an increase in our share price as a recognition of the investment community that the company is in better shape. We have also been seeing significant institutional funds coming into the company, and we feel we'll keep working towards creating more awareness about the health of the company and our plans going forward. So we're happy to see the stock price reacting to the strong economics of the company, but we look forward to keep working hard and making sure that we keep advancing and making the company a stronger and a safer place for our investors to come and invest. We believe in values of life for sure, and for us, the Sustainable Development Program from the United Nations is a reference to our activities towards the communities and stockholders where we do business. We invest significant amounts of money in the children, especially in schools, in food, in programs where we taught them how to grow and build a better living in those communities. I kindly invite you to scan our sustainable report in the QR code here, as it has a significant amount of information which we would love to share with our investment community. We have in place a committed and experienced management team and a strong board of directors where of which we keep them posted on our day-to-day decisions, especially on those important ones, and we definitely work on their guidance and in an institutional way of doing business. The new Santa Cruz, as we like to call it, it's a company that it's a multi-metal, multi-asset mining company, a multi-jurisdiction, and I would like to say a multidisciplinary company in terms of the mining approach that we have, since we are experiencing or we have different geological deposits within our portfolio. We have a multidisciplinary team that feels comfortable on carrying on the best practices at wide ore bodies, as same as very narrow or vein bodies. No, we have a high quality silver and zinc reserves, which we keep increasing year over year. We have a strong policy of inventorying resources as we are depleting them and mining them over the years. So with that in mind, we want to give our mines a long life for the future to come. We have a strong and disciplined financial approach. We have a financial position today that brings the company to let's say to a stronger position to take advantage of today's situation in the mining industry. We also have a significant exposure to silver, with silver being north of 50% of our revenues. So we believe we're presenting to the investment community a strong business model for them to come and grow with us as a company.
Yeah, I think, Ben, that we are giving the investor community a diversified asset base. We also are giving them exposure to two very important metals, silver and zinc, and we also have a strong position to continue to grow. So yeah, I think that's the value we're bringing, the opportunity we're bringing to our investors community.
Correct. And by year end, I mean by October, we'll be amortizing the full amount of our Glencore cash consideration. That will put us in a very strong position as well. We have no bank debt other than revolving facilities, which are just to keep our treasury working in an efficient way. So we have no streamings, no royalties. So that being said, our investors will be leveraged completely in these two metals when coming into investing into Santa Cruz.
Great. Well, yeah, and so firstly, I appreciate you walking us through the story, and it is a great story. You know, it's quite impressive what you guys have done since 2022 to where you are today. And just going back, I think before we get into some more recent updates and questions, I did want to have you just explain a little bit of the renegotiation of the Glencore transaction and the deal there, because previously, you know, a big knock on the story was this Glencore debt and transaction that was sitting there, whereas this renegotiation has really changed the story, and it does sound like you're going to be able to have this fully done with by the end of the year. So maybe you can just provide a bit more detail on that.
Yeah, absolutely, Ben. Well, the initial terms from our share purchase agreement were, let me put it this way, 4 items were the most important. First, a cash consideration for $110 million. When we closed the transaction, we amortized around close to 20 million. So the cash consideration at that time was $91 million. There was also an NSR, or an inventory profit, that was left in our patios. That together with an NSR that all the assets have in that agreement, both combined were around $15 million, which we need to pay to Glencore at that time. Also, all the value-added tax that was incurred by Glencore on those years that they were running these assets, close to $60 million, $56 million, were meant to be paid to Glencore or returned to Glencore once we receive those monies from the Bolivian government. The total consideration was close to $163 million. Terms after the share purchase agreement renegotiation were more simpler. There are two simple items, no? The cash consideration, which at that moment, I mean, with today's value is around $26 million. The cash consideration and the CVR contingent value rights. These are the only two items. Cash consideration, we have the choice of, I mean, the ability to pay it in two different ways. Either we paid $40 million on or before November 1st, 2025, or we choose to pay $10 million from there on every year for the next 8 following years. So that means $80 million over 8 years. As you know now, I mean, we choose amortizing and paying the $40 million before November 1st, 2025. Today we have paid $17 million. We still have $22 million to pay, but we have the monies to keep making those payments as they come due. And then we have a consideration, a contingent value right. The contingent value right is capped at $77 million, and the contingency for this, or the trigger for this to occur, is having zinc at north of $3,850 per ton. At that moment, we start paying $1.3 million a month with a cap of around $16 million for the year. So those are the only two payment considerations. In addition to that, in addition to that, we're keeping all the value-added tax now for our own working capital, and we are getting rid of the NSR. We have no NSRs anymore in any of our assets, and we also keep close to $9 million on the inventory profit that was left at day one. So we're in, let's say, in a better position to leverage now in today's metal prices.
Yeah. So Ben, I think something relevant is we were from around $170 million total consideration that took 5 items. We reduced those to 2, and of those 2, one is a CVR, which is contingent to something happening. So I think that's the most important thing. We have almost the same amount, but we reduced from 80 million, we reduced it to 40 million because we are now taking the option that we send our clause of the SPA contract. But also this contingent value right, it only goes off if zinc is above $3,850. So we would love to pay that, you know. So yeah, we are in a much better position on simple terms.
Correct.
Yeah, understood. And just this graphic on the right obviously highlights paid 10 million in March in Q1, another 7.5 in Q2, and then you've got 3 more $7.5 million payments, and you should be free and clear by the end of October of this year.
Yeah, our treasury now is very strong, so we will not expect anything to change there. We are going to commit to that.
Great, and then so that actually brings me to my next question. Is obviously you're generating a lot of cash right now. Of course, you want to have a certain level of cash in the bank, but what is your plan once all of these payments are done and you're free and clear? How do you plan to allocate capital going forward? Are you going to look for other acquisitions given your success over the last few years? Dividends, buybacks? What do you have any plans and initiatives for that cash that you'll be bringing in?
That's a very important question, Ben. And in this year, our objective and main focus is to finalize our payments with Glencore, close the year with a very strong treasury, and just being disciplined. We're starting to think about what will be up for next year to keep growing and developing the company. And we have different alternatives. Organically, we have the Soracaya property, an exploration, a brownfield property, which we might start thinking about how will be the best way to develop that mine and bringing it into production. But we'll have the ability to look something out of our portfolio as well, since our treasury will be significantly strong by year end, as we keep walking the year with today's production and today's metal prices. So that's something that we're thinking and we'll be defining a clearer way to go in the next coming months. But definitely this year will be just getting our minds to reach the best and most efficient operating, ways to run and increase our treasury.
And, and Arturo, I think that is very important. You know, we have been focusing on process optimization. We have been doing that, for example, in our Caballo Blanco operation. We want to replicate that in other operations. Of course, we're focusing on paying Glencore. That's key for us. For us right now, we will have the asset, the Soracaya asset. We are doing some investments there, and also we have done a lot of investments. If you go to our MD&A, then you will see that we have invested a lot in Mexico because we believe level 96 is the future of that mining. So we have invested a lot of capex there. We are also improving some structures here in Bolivia. So yeah, 2025 will be focused on process optimization, paying Glencore, and putting our mines in the best position.
Right.
And I think, Ben, that considering that we are, this year alone will be north of $110 million EBITDA for the year. I think that we still have some recognition to be done in the markets in terms of our share price today. I'm not the right person to set what I think the stock price should be, but I think that we still have room to keep going and that will give our investors an upside, a natural upside, just by that.
And then remember that Arturo was saying that we are also a multi-method company. So that put us in a very good position, because if we find another assets, another acquisitions, we have the team in order to do that, to take advantage of that. So yeah, of course, we are always open to see another opportunities, but now we're focused on giving the true value of these assets.
Yeah, absolutely. And so you mentioned CapEx there. I did want to, before pivoting over into Mexico, talk a little bit about the Bolivian assets, the mine lives there. I know they are not overly long. Some investors like to see growth in terms of an outlook on mine life. With this expected cash flow, do you have any plans to accelerate your drilling campaigns, try to extend those mine lives? What are your sort of plans from an exploration standpoint?
That's a good question, Ben. And actually, there's a few reasons why our resources are where they are today. And one of the reasons is when you have narrow vein systems, sometimes making or inventorying more and more resources became more expensive. Sometimes it's even better to develop and then open new areas to start your exploration activities. Otherwise, it makes it really expensive to keep your drilling programs ongoing. So for us, having 3-4 years of mine life in the narrow vein system and a very strong conversion rate, sometimes even north of 2 times the conversion rate from inferred to graduated to reserves. So that being said, we feel comfortable that as we keep doing infill drilling, as we keep doing exploration programs, we'll keep inventorying more and more resources. Remember, these are mines that they have been running for generations now, 200 years, even 500 years for Porco, for example. And these are mines that they are open, as you can see in our technical reports, they are open along strike and at deep. So hopefully you can join us in one of these site visits this year, and you will be able to see firsthand why is it that we clearly see that these mines have upside potential as we keep moving forward.
And also, then we need to consider we have a lot of inferred resources, as Arturo was mentioning. The life of mine is based on reserves alone, and we use prices of 2023 because our national instrument 43101 was done in 2023. Remember, with current prices, those reserves should be a lot stronger then because you need to use current prices as well as projected prices. So yeah, we feel very comfortable because, as Arturo was mentioning, having 3 to 4 years of life of my mine, and we are always building the same thing. If you go back to 2022, we have 3 years, 4 years. So we are always with the same life of mine. So we're constantly with the same thing, and we feel comfortable with that amount of life of mine. And we understand that sometimes investors want to see a little bit more, but I think the explanation Arturo just gave them that it's expensive to do that in a narrow vein system, and to keep that, it's very healthy for us. So we believe that on operational basis, that's the way to go.
Right. Understood. And then so just pivoting over to Mexico, we saw in Q1 elevated capex relative to what we were expecting. Maybe you can talk about what that was for and what we can expect going forward.
Yeah, definitely. Since maybe a year and a half, Ben, we have been doing a lot of capex investments in Mexico. The Zimapan mine has a very strong potential. In level 960 is an area that we want the company to grow or the mine to grow, to develop, because we have identified this as a significant area. And with that, we have been investing every month since year and a half on underground equipment. We have been receiving a lot of underground equipment. Just to give you an idea, more than 18 underground brand new equipments, which are expensive, as you know. And during Q1, we got 3 large or big scoop trams, in addition to other smaller equipment, all of them at the same time. So we registered those as a capex one-time expense at the moment, but you will see more normalized capex or all-in sustained cash costs, at Zimapan in the next coming quarters. But the reason for that has been the expense, the capex that we have been doing, and the reason is very clear. The mine has a significant upside potential, which we want to take advantage of.
And also this Q1, we spent most of our budget for the year because we want this equipment to be ready now. Yeah. So yeah, we expect this CapEx going down for the next quarters. So it's actually a good thing to have that. I know it reflects expensive right now, but it's a good thing because we have invested this quarter more than that we were going to invest the following. So we'll have the equipment ready as soon as possible.
Right. Understood. And then just to sort of summarize more broadly, we were obviously very impressed with the cash costs and all-in sustaining cost numbers. I know we had previously guided to the market that your previous cash costs and AISC numbers were slightly higher than reality due to the exchange rate, methodology that we spoke about. So just to touch on this one more time, going forward, the exchange rate methodology has changed. It's going to be consistent, and therefore, should we expect costs to be right around sort of where they were in Q1?
Yes.
And can you just touch on the rest of the year from that perspective?
Yes, that is correct, Ben. And it's important to know why. The macroeconomic, this change that we have done because of IAS 21, it's a macroeconomic change and shift in the country. So before, all these gains were put on the FX exchange gain because it was considered kind of a temporary thing. But now, when you look into the country's central bank reserves, etc., and their position against commercial partners, you definitely know that the market exchange rate is actually around 12, 13 or 14. That's the new thing. So for us, it was the good thing to do. It was to put it as it is truly there in our costs. And now it reflects the economic reality of this. So from now on, you should expect to see cost of around 21, 22, and that could even improve. Of course, with these new exchange rates, some imported things are getting a little bit expensive, but on abroad, we should expect to continue this. And that's why it was important for me to tell investors, this is not a one-time thing. It is actually, now we are a Bolivian operation, which is cheaper than we used to be. And yeah, recording this and the effect was no longer correct. We believe that now that is on cost, it really reflects our economic reality.
Right. Right. That makes sense. And again, just to sort of cap off Q1, obviously quite a great quarter, 27 million or so in EBITDA. I know the net income was a little bit less because of the Glencore payments as well as the 2024 tax. So it will be another sort of step change for Q2 on the net income perspective because you won't have that tax payment. But nonetheless, gentlemen, we're getting close to time here, so I do appreciate the time walking us through the story top to bottom, as well as to getting into some of the specifics around 2025. Yeah, quite excited for the rest of the year. There's a lot more meat on the bone, we believe, from a share price perspective. Again, given 100+ million in EBITDA this year and where your market cap is today, despite the stock doing really well over the last few months. And then lastly, just for our followers, if you haven't seen our research on Santacruz, you can find it all on our website at atriumresearch.ca. And again, Arturo, Andres, thank you for your time.
A pleasure, Ben. Thank you for having us
Sure.
here.